vacancy rates at the moment in secondary office, they're as high as 20%.
It will have an impact on sentiment, but we don't believe it will have a major impact on earnings.
There's a bit of an impasse as vendors' expectations are sort of still set a little bit on where pricing was. We're sort of seeing a lot less acquisition activity right now.
Rising interest rates and the risk of a recession have hit pause on investors' passion for listed property and driven a significant decline in the sector's pricing on New Zealand and Australian markets. I'm Madison Reedy from Jarden, and I'm going to invite our listed property analysts to explain how these pressures are impacting occupancy in office space and could alter the recovery for retail. However, with decent demand for industrial space, there could be some value emerging for investors. Jarden's Head of Research, Arie Dekker, says the listed property sector has had a golden run in recent years, but the valuation gains that have supported strong growth in the size of their portfolios have been largely impacted in the first half of this year.
Yeah, over the last 6 months, we've seen some of those gains retraced. The sector in New Zealand's down 10 to 15% across the board. So on the acquisition front, there's also been a lot less activity over the first part of this year, and that's really just a readjustment to those higher interest rates. Purchasers are having to sort of relook at what they're willing to pay for assets, knowing their funding costs are going to be higher, whereas there's a bit of an impasse as vendors' expectations are sort of still set a little bit on where pricing was. And put those two things together, we're sort of seeing a lot less acquisition activity right now.
There's been a lot of commentary about what post-pandemic flexible working arrangements could mean for occupancy rates in offices. Office vacancies have increased overall, but there are differences across the sector.
Occupancy rates in Auckland secondary office are quite high. They're as high as 20%. In prime assets, it's a lot lower, below 10%. In Wellington, in fact, prime office vacancy is sitting at low single digit. There's definitely a very big difference between higher quality office assets and those secondary ones. Occupiers are really focused on creating the right environment for their employees to come back to work. There's very strong demand for assets, and buildings and good locations, but also there's a lot of effort going into the fit out and amenities that are being provided for staff in the office building. So because of the construction of prime assets, there's a lot more supply there, and that's filtering through to seeing occupiers move out of secondary assets and take up some of this new space.
Like offices, retail has reopened and consumer spending has come back strong post-lockdowns. Jarden's Head of Real Estate Research in Australia, Pirenc, says that retail would be impacted by a possible consumer slowdown in New Zealand or Australia, but he remains positive on the outlook for owners of large retail assets like shopping malls.
It will have an impact on sentiment, but interestingly, there's a number of offsets why we don't believe it will have a major impact on earnings for the mall REITs in the near future. The most important one is the fact that we've just come out of COVID lockdowns, and these companies, these landlords still have millions of dollars of rents that wasn't collected during COVID or during the lockdowns, but will be collected going forward. So even if the sales growth of a tenant slows down, it means that there's still a significant amount of rents that will be collected. The second part of that is the fact that most of these landlords get CPI plus or fixed rental growth, irrespective of what happens to the top line growth of the actual retailers. So that gives us confidence that the rental growth of the retail malls will actually be very strong.
Commercial property's industrial asset class is also showing signs of resilience, with strong demand for storage and warehousing space. Industrial vacancies are at record low levels, and rental growth has been strong.
The outlook in industrial is very positive at the moment. Demand is exceeding supply. There's a lot of new building going on, but market rents are at double-digit levels. So the outlook for industrial right now is very strong. And that should also impact through as a bit of an offset to some of the pressure on valuations coming from higher interest rates.
Jarden analysts are seeing some listed property firms develop new assets to meet increased demand in the industrial asset class. And they're seeing strong tenant interest for new high-quality office developments. However, Jarden expects that in a higher interest rate environment, the level of acquisition activity across office and retail property asset classes could slow down, as the gap between vendor expectations and what the market is willing to pay or able to afford widens in the near term. Stay tuned for more analysis of what's happening in the global economy in our next Jarden Insights.